Today's episode of Hidden Forces is made possible by listeners like you. For more information about this week's episode or for easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you listen to the show on your Apple Podcast app, remember, you can give us a review. Each review helps more people find the show and join our amazing community. And with that, please enjoy this week's episode. What's up, everybody? My guest today is Tom Derry, CEO of the Institute for Supply Management, which puts out the market-moving PMI number on the first business day of every month. As CEO of ISM, Tom has a unique vantage point, observing major macroeconomic trends and developments through his daily contact with Fortune 500 companies, government agencies, and NGOs in the United States and abroad. This was super educational for me. Not just my conversation with Tom, including everything we discussed in the overtime, but also all of the work I put in preparing for it and what I learned about the evolution of global supply chain networks over the decades, from the development of just-in-time manufacturing to low-cost sourcing, automation, and logistics, the underbelly of this iceberg that makes up global trade and commerce, all the things we consume and rely on every day that come to us through this complex, interconnected web of processes and relationships that we cannot help but take for granted. And yet, we are learning through this recent crisis and the impact of COVID-19 about just how critical and in some cases fragile these supply chains and networks are and can be. In the overtime, Tom and I discuss a number of additional sectors, including services like travel, restaurants and hospitality, automotive, telecommunications, construction, and warehousing. But the most interesting part deals with the long-term impacts to these global networks due not only to COVID-19, but the larger forces of mercantilism, retrenchment, and disorder that we've talked about on prior episodes and which are rerouting supply chains closer to home, reducing choke points and vulnerabilities that we've seen revealed by this latest global crisis. We also discuss the possible threat of inflation seeping into these networks and how this could cause further disruptions in systems optimized for efficiency and which depend on reliable pricing for components up and down the supply chain. And with that, let's get right into this episode and my conversation with CEO of ISM, Tom Derry. Tom, welcome to Hidden Forces.
Demetri, it's my pleasure. Thanks for inviting me.
I'm so excited to have you on, Tom. I geeked out over the last few days over your reports and just in general looking at throughout the internet, trying to learn as much as I could about some of these major sectors like automotive and manufacturing and shipping, which is super interesting. Actually, one of the things that I was most interested in is the challenges that both shipping companies and trucking have in terms of needing to coordinate freights from inbound to outbound. So there's so much I want to geek out with you about today. First of all, for our listeners who either are not familiar with ISM at all or have heard of the ISM number, but that's about all they know, what is ISM?
Yeah, the Institute for Supply Management was founded in New York City in 1915, so we're 105 years old. And what we focus on is the supply side of the economy. Traditionally, our members come from larger companies, and they're responsible for understanding the upstream demand that they're creating for their own suppliers and satisfying the downstream demand that they're satisfying with their customers. And it's their job to keep that supply and demand equation in balance. And as a result, we have a very unique and very informed and extremely timely point of view on what's happening in the real economy and how that affects the overall economy of the United States and globally.
How long have you guys been around?
Since 1915.
1915. And when did your number become market moving? Because for years I've known about ISM just because every time you guys put out a number, it's one of the more important statistical indicators.
Yeah, it's normally big news on the day of release. So we've been publishing it since before World War II on the manufacturing side and since the 1990s for the services sector of the economy. I have to say, though, that what really put us on the map was a famous quotation from Alan Greenspan back when he was Fed chair. He was asked, if you could only have one leading economic indicator, which one would it be? And he chose the ISM number. So that really got people's attention.
And he is a notorious data sleuth. That's a great endorsement. Of all the people that can endorse you, Alan Greenspan. So what is it that attracts you to this work? What is it about supply chain? Well, it's not supply chains, right? How do you define it?
Yeah, so that's a really good question, an insightful question, Demetri. We actually think supply chain is a little bit of an outmoded term. I understand why it made sense back in the 1980s when people began to think about this set of activities that needed to be coordinated in a more efficient way. It made sense to think of these activities sequentially and in a linear fashion as activities that were linked, and supply chain was the obvious metaphor. But in reality, it's more of a network or even an ecosystem. And companies at the top end, the buying companies, the OEMs, if you will, they're orchestrating an ecosystem that they need to produce their own businesses and run their own businesses. And so it's really more of a biological metaphor, if you will, in terms of what describes the activity that is necessary to support, whether it's a Mr. Coffee machine that you're buying or an Apple MacBook or a Ford automobile. It's all supply chain, or pharmaceuticals, the medication you may take. It's all supply chain that supports the activities that result in those products being available to consumers. So it's a fascinating field. It's not simply the economics, which are in and of themselves fascinating, but you think about our ability to impact the world. China is the obvious example, but the amount of people we've moved from rural China and states of poverty to the eastern cities of China in high-paying jobs and raising their standard of living. That's just one example. So impacting the standard of living is something that's real and that we're very proud of. When you talk about sustainability and our ability to produce products that use their ingredients or their components in a responsible way, in an environmentally sustainable way, but also business models that are sustainable, that's a huge impact that supply chain can have. So we think that when you're dealing with issues like national security, even the Huawei debate and whether or not those components in telecommunications may or may not be at the disposal of the Chinese government in terms of espionage directed towards economic or military activity in this country. We touch on national security, fair labor practices, the environment, economic prosperity around the world. It's a wide field, so very fascinating.
So because of this recent crisis, I think, and not just this crisis actually, really since the beginning of the trade war, whatever you want to call it, with the Trump administration and China, many Americans began to hear the term supply chains or rerouting of global supply chains. How complex are the global supply chains and systems, and how much have they changed over the years, especially with globalization, specifically with globalization? And also, how much do people, do you think, who aren't in this industry take this for granted?
Well, there's no doubt that the average consumer takes for granted the quality of the products that are on the retailer's shelf, or the quality of the technology that's available to them, all of which is completely dependent on supply chain. So, the world's largest contract manufacturer for electronics is a company known popularly as Foxconn. And Foxconn employs hundreds of thousands of people to manufacture the iPhones we all carry in our pockets in China, as an example. So the fact that we're able to communicate as efficiently as we can with all of the technology that's embedded in that miniature computer that we hold in our hands, it's all supply chain enabled. It's also true that we enjoy everything from food and beverage that we eat and consume to products that we use for travel, to our household products, to personal hygiene products. Much of the base components and raw materials are ultimately sourced from China. Even if you think that, you're a local branch of a Marriott hotel, Marriott may source its textiles and its linens from a domestic supplier, but that supplier's in China. So we actually have a an economy-wide dependence on what's coming out of China here in the United States. And that's because historically, over the last 30 years, China enjoyed a massive advantage in terms of labor costs. And that's what drove the standing up of manufacturing in China from the late 80s and into the 90s and beyond. Then you had China's accession into the World Trade Organization, the WTO, beginning in 1995 and completing in 2001. And so they became this major trade power. They're the world's largest exporter and the world's second largest economy driven by exports. So that's kind of the scale and complexity at the macroeconomic level of what we're dealing with. When it comes to the individual consumer, they probably don't appreciate that any single device that you touch and the dozens of devices that you use over the course of the day has some component, whether it's a rare earth metal that's necessary for electronics, or it's a base chemical that goes into paint that you may be painting your child's bedroom with, or any other device that you may be using, or any other product. Much of that comes through China.
So I actually do want to talk about China because it's an interesting story. Before we talk about that and the way the trade war has impacted or laid the foundations for what we're now seeing in an accelerated form with COVID-19, I'm curious when supply chains began to transform themselves from what we had in the past, where a lot was warehoused or stored in the actual store, which is where we get the name store, and to how we transitioned into this, what we call just-in-time manufacturing. I'm very curious to understand how this transition occurred.
Yeah, the economic history, I think, is fascinating, and you're dead on point there, Demetri. So there was a time in the late 80s and early 90s that many people will recall when, the so-called era of Japan Inc. and Japanese automobile manufacturers were selling their cars in big numbers over here, and the big three in Detroit felt very threatened, and the Japanese were clearly making high-quality cars, and a big secret to their success was something they invented called just-in-time delivery, just-in-time inventory. And that's merely the practice of having components roll up to your factory door just as they're required to make the next automobile, as opposed to sitting in a warehouse or distribution center, for 6 or 8 weeks before it eventually makes its way to the factory for manufacturing. There's a lot of financial waste that's involved in building up an inventory and having it on hand. That's money that can't be used. It's working capital that can't be used for other purposes by the company while it's tied up in inventory. So the Japanese practice or invention of just-in-time inventory was a massive accelerant of this move towards globalized supply chains. I mentioned the labor arbitrage opportunity that existed with China in the 80s and 90s. That was another massive accelerant. And the third one, I think, is sort of philosophical. It's really unknown to most people, but it's a startling transformation in the philosophy of how American businesses run. If you look at the S&P 500, the companies that were in the S&P 500 in 1970, so 50 years ago, more than 80% of the cost structure of that business was spent within the four walls of the firm. Today, that's about 50% or a little less, which is a 60% reduction and is a massive change. In other words, we realize that we have core competencies as a company. And part of our core competency may not actually be in maintaining inventory or distribution and logistics or running warehouses. Is probably just in the manufacture of that product, for instance. And along with this recognition that we needed to focus on our core competencies and we could rely on third parties to deliver those services and products that we need at lower cost more effectively, because that's where the comparative advantage lies. At the same time, we realized that there was a sort of profit pooling that happened at the OEM level, what we call the rise of the factoryless goods producer. And a great example of a company like that is Nike. Nike doesn't want to own factories. They want to do the research and development that results in the Vaporfly shoe that's been controversial in marathoning circles recently. Or back when they manufactured golf equipment for Tiger Woods, it was around the golf equipment to make that higher performing equipment. They wanted to do the R&D. They wanted to own the marketing, but they didn't want to own the manufacturing assets. So they contracted that work out. Google does that now. You can buy a Chromebook from other people. They design the Chromebook, but they don't want to own the manufacturing around making that computer. So the rise of the factoryless goods producer is a result of these other changes, just-in-time inventory, the recognition that we've got core competencies and we don't want to be involved in other things. And as a result, we've really got this third sector of the economy that people don't appreciate. We think of the economy as being manufacturing and services, but now there's this in-between category, the factory-less goods producer.
Fascinating. You mentioned the term OEM before. For those who aren't familiar with that term, OEM means original equipment manufacturer. It applies to sectors like automotive, companies like Ford and Volkswagen, for example.
That's correct.
And auto is a great sector to talk about because it's one area where we've seen an explosion of small suppliers.
Yeah, in fact, most suppliers are relatively small compared to the big brand names that we all know. The Fords, the General Motors, the Chryslers, the suppliers, the people who make the axles, the brakes, actually the seats themselves. The seat in a modern automobile is the most expensive part. Most people don't realize that a seat itself can cost Ford Motor Company $10,000 because it's so complex.
So this is really super interesting to me. Are there any books you could recommend that actually discuss the history of just-in-time manufacturing in Japan during the late 1970s and early 80s?
Yeah, there are several, but there is a book called Japan Inc., which is a very good read on the psychology of America in that time, feeling very threatened, and the sort of world economic dominance of Japan in that era. And then, of course, it didn't quite materialize the way people expected it to, because Japan went into a long period of kind of stagflation, and it still is experiencing that kind of weak economic growth today. They're over leveraged as an economy. They have too much debt relative to their GDP. They have an aging population. So they've got some structural issues that are preventing the kind of continued dominance on an economic basis that they had back in the 90s. But that book in particular is a good read in terms of understanding what was happening back then and their success. Coming out of World War II, remember, their economy was ravaged. So along with Germany and a few other notable examples, South Korea a little bit later on, these economies turned themselves around by focusing first on manufacturing relatively low-value goods, mastering that work, moving to higher value goods in the value chain, and then very complex goods like automotives and electronics. So it's a fascinating story. It's a question whether that playbook will work going forward as the world moves a little bit to a post-manufacturing economy. Is that playbook around, let's get good at manufacturing, build our base there, and then move into the services sector? Is that the right playbook for emerging economies going forward? It's a question economists debate.
So one of the things that's really interesting about this is that we tend to think of distributed networks, at least because of IT, as being more resilient. But in this case, in terms of supply chains, what I feel like we're seeing is the tariffs and this recent crisis with COVID-19 has exposed some of the fragility of an economy that's built on outsourcing and just-in-time inventory. And there seems to have been this trade-off, or there is this trade-off between efficiency and resilience in the supply chain. Is that something because of how these companies have managed that supply chain, or is it just part of what it means to operate a distributed supply chain in manufacturing, let's say?
That's a really insightful question, Demetri, and I think you're absolutely right. There has been a trade-off. We've accepted a trade-off between, say, very efficient, lowest cost supply chains and fragility is an excellent word, the hidden cost, the vulnerability to disruption that exists with those very efficient supply chains. And there are two primary reasons for the fragility in supply chains today. The first is, in order to get lowest cost, what the big companies, the buying companies want to do is send as much of their spend volume to the direction of one supplier as they can, right? The old idea that the more volume I send, the lower cost I get. Now, they work on identifying high quality suppliers and other factors that go in. But the promise is, if I give you 80% or 90% or 100% of my business for this component I need to buy, what will your price be? And they're driving towards that lowest per part price. And when they do that, they tend to rely on a sole source supplier or a single source supplier. And there's inherent risk there, because if there's a fire in that plant and it's a sole source supplier, then you're really struggling to replace that supply. And that's exactly the scenario that played out with coronavirus in China, where we had production going down to 50% levels, and there was no other place to turn quickly to replace that sole source supplier. The other factor, to answer your question, is something that the academic literature calls a nexus supplier. It turns out that in many industries, 3 or 4 or 5 tiers down. And by the way, most companies really only understand their first tier suppliers. They only understand the companies they do business with directly. But they in turn have suppliers, and those suppliers have suppliers. So you're getting into second and third and fourth tier. Inevitably, almost, there's a common supplier buried 3 or 4 tiers down that everyone relies on, but not everyone knows it. And if that nexus supplier experiences some kind of disruption or outage, it could just be financial stress, but it could be a weather event or a geopolitical event. Turns out every single company in that industry is dependent on that nexus supplier. And we've seen that happen in automotive as one example in the past. So two critical attributes of supply chains that make them especially fragile. And I think we're seeing people learning the lesson of driving towards efficiency at the risk of resiliency, as you pointed out.
Wasn't there another case of this with cell phones, that all cell phone manufacturers had some common particular supplier of one particular part of the device recently with what happened in China that got impacted?
There are some, I can't think of a specific example related to cell phones, many of which different brands have different supply chains. But for instance, rare earth minerals, which are so products like tantalum, for instance, which are critical to make the semiconductors and chips that go into cell phones, 80% of the world's supply is in China. So if that supply were to be at risk, our ability to manufacture laptops, cell phones, components in our automobiles, which are highly electronic these days, would be severely impacted. So China has a virtual monopoly on rare earth metals, which is not well understood. Qualcomm makes the chipset that enables most of the mobile phone communication in the world today. It has a virtual monopoly on that chipset. So there's an effort to invent some other chips to reduce that, but Qualcomm has that capability today. And going back a decade or so, Apple did have an exclusive relationship with a supplier that manufactured Gorilla Glass, the glass that the highly resistant glass that was fracture resistant, and it realized it was a competitive advantage, and so it locked up the world supply of that particular glass, so that Samsung and others didn't have access to that supply, and so they had a competitive advantage when they were getting to the retail level.
So I also remember examples of this with Fukushima, right? And actually, when I was reading up for this conversation, I saw a lot of references to Fukushima and to SARS as periods where manufacturers had opportunities to learn lessons. And in some cases, perhaps they did learn lessons. In some cases, they didn't. I'm curious how this crisis is different. And when I say this crisis, I would love for you to also bring into the conversation the trailing impact of the tariffs, but how this crisis, this situation that we find ourselves in, is similar to or different from, let's say, Fukushima or SARS.
Yeah, well, I think you've brought up two very relevant milestones in sort of the history of supply networks and their development. When you go back to SARS in 2002, the key factor to remember is that China was not nearly so integrated into the world economy as it is today. At the time, I think China represented something like 3% of world GDP, and today it's something like 16%. So it is a major player. When China slows down, it affects the entire global economy. In fact, when you see slowdown in China, one of the underappreciated ripple effects is so much of the manufacturing equipment, the heavy machinery that China relies on, is actually made in Germany and exported from Germany to be put on the shop floor in China. So when China sneezes, Germany catches a cold because its export economy is heavily dependent on exporting manufacturing machinery to China, among other linkages between the two economies. So when you think back to SARS, first of all, we weren't nearly as integrated as we are today. So it was an entirely different world. And we also weren't as integrated just in terms of our global travel. People didn't travel nearly as much as they did back then. So the ability for the virus to spread is definitely greater today than it was back in that period. In the case of Fukushima, there was some interesting learnings that I don't think we probably took to heart. One of them, it was devastating personally to the Japanese people. We should never overlook that. But from a supply chain perspective, it was relatively local in terms of its impact. I mean, for instance, and kind of interestingly, one of the factories that was shut down was a factory that produced the red pigment for Toyota automobiles. So
that's the story I remember. That's the story I remember.
Yeah, you couldn't get a red Toyota because there was no red pigment available, which is sort of interesting, right? You think of these things, and even if you wanted one, you couldn't buy one. So, and that happens. I'm aware of a pharmaceutical company, for instance, very similar situation. There was a fire in a manufacturing plant in Japan. They sourced the coating for a consumer medication that went on this tablet from that one plant. And it was about a $2 billion a year in terms of annual sales for this medication, but the coating was only $200,000 a year in terms of expense for the company. So in terms of its risk analysis, it didn't even look at a level of spend so small. However, when the fire hit and the plant was going to go offline for 9 months, they were going to lose the ability to produce this medication. And that was $2 billion worth of sales to this company, which is a big number for any corporation. So, we have to realize is that what can look like a small amount of spend typically often supports a high level of sales or revenue at the consumer level. And it does get the CEO's attention, does get the board's attention. So one of the lessons we failed to learn, I think, from Fukushima was that geographic concentration matters. Now, in the case of Fukushima, it was limited to a handful of industries primarily. We also had flooding in Thailand back a year earlier to that affected the hard disk drive manufacturing business, which was highly geographically concentrated. What's new about this crisis is that the geographic concentration is an entire country, an entire economy, and the interdependence of, for instance, the entire U.S. economy on the entire Chinese economy. That's a level of scale that we've never seen. We've seen scale that impacted industries for a period of time. We've never seen economy-wide impact, that it looks like it's going to be of several months duration at a minimum. So that's a significant change. And I'm glad you brought up tariffs because the tariffs are still there. They haven't been lifted despite the crisis. And companies in the United States in particular were clearly taking proactive steps to minimize the impact of the tariffs on their businesses going forward. So when we saw 25% tariffs proposed late in 2019, for instance, many companies were buying inventory ahead to get that inventory into their warehouses in advance of the 25% level of tariffs. The 10% level tariffs were almost absorbable. I mean, most companies took a calculated risk that those 10% tariffs were not going to be permanent. They were going to be temporary. And for a short period of time, we could absorb them and maybe share them between the supplier and the buyer. But at the 25% level, most company margins aren't big enough to withstand a 25% hit. That would eat your entire profit. So at the 25% level, it became very serious. So companies were already taking steps to diversify their supply networks, move into other countries, qualify different suppliers, buy inventory ahead, regionalize their supply networks, not relying less on one globally extended linear supply chain to China and building global networks to replace that to a certain or augment it to a certain extent. So that was already happening in 2018 and 2019. And what happened with COVID-19 is only accelerating that change.
So would you say that in some ways it's a good thing that we had the tariff war heading into this because companies were already beginning to recalculate their risk of suppliers and things like this? Would it have been worse if this hadn't happened?
Yeah, I mean, that is the ironic dimension to this current crisis is that the tariff imposition did force companies to deal with some of these impacts that would have only been worse had we not taken some proactive steps to, stand up some suppliers. And by the way, it was also true from the Chinese side. What I think is fascinating is that Chinese, especially the private enterprise companies, not the state-owned enterprise companies so much, but the private enterprises said, these tariffs are bad for my business. They took their Chinese managers and moved them to Vietnam and other countries and stood up facilities over there and moved their manufacturing footprint out of China to other places in Southeast Asia because the ongoing tariff environment was untenable for them. So it was not simply U.S. companies doing it, but Chinese companies also recognizing that if this is going to be a permanent feature of our trade relationship, we need to take some proactive steps.
So this is fascinating. I have a question about a term because when you were talking about Japan, not the company that produced that paint for that Toyota, but it was the second example you gave, it reminded me of this term that I read in one of your papers called total cost of ownership. I'd love for you to maybe break down that term first, like what does it mean? And then kind of to continue with this point, this larger point, what are we learning about which companies or what percentage of companies had a good sense of their total cost of ownership heading into this supply crisis?
Yeah, it's a really good question, and it is a term of art in our field. Total cost of ownership, sometimes referred to as total landed cost. And what that means is it's not just the cost that I paid for the widget, but the cost it takes to acquire the widget and move it from wherever it is and get it to a warehouse and then ultimately get it to my manufacturing facility. And by the way, the total cost of ownership also includes concepts like what's the quality of that product? How reliable is it? Do I have defects in manufacturing that I encounter? And so I have to take that into account in terms of ordering additional parts or reorders. So when we're focused exclusively, as we were primarily over the past 30 years, on just the part price, we're overlooking that total cost of ownership. And that's played out very dramatically in the current COVID-19 scenario, because one of the things that happened is China was going into lockdown, and as a result, factories were shutting down and unable to manufacture. We had a virtual lack of exports from China moving in the direction of the United States. Some estimates were as high as 75% of the normal traffic that moved across the Pacific Ocean from China to the United States to U.S. ports in the month of February disappeared. A 75% disruption.
Wow.
And yeah, pretty astonishing. And as a result, we had container ships stacking up in the ports in China, but we had no workers there to decongest those ports. If you're looking to move, and now you need to move because, first of all, you probably anticipated the Chinese New Year and built up a little inventory because you knew that production was going to be lower during the Chinese New Year. That's an annual event that we anticipate here in the United States now. It doesn't catch us by surprise. But when that was extended as a result of the coronavirus outbreak, that did catch us by surprise. And if we were expecting to be able to replenish our supplies normally after the Chinese New Year concluded, and now we found that we can't, and by the way, our factories are only operating at 50%. So our lead times have doubled, meaning if it takes me 6 weeks to get that stuff shipped, I now should expect a minimum of 12 weeks, but I'm operating at 50% capacity with my suppliers, so I have to get at the end of the queue. I might be looking at 18 weeks. All of a sudden, the total cost of ownership skyrockets because I have to find some way to get that product over here. At the same time, we canceled most U.S. passenger flights to and from China and the United States. What people don't realize is the cargo holds of those planes don't carry suitcases. They carry industrial components and parts and electronic components and big stuff like engine blocks too. So all of a sudden, our air freight capacity and our ocean freight capacity is practically at a standstill. Now, if I need to get that product, I have to either charter a private plane to move it or get allocated space on some of the few container ships that are moving. And my prices to get freight on those two modes of transportation have gone through the roof. So now my calculation around, but I got a great price for that widget no longer applies, because by the time I get that widget to the United States, I may pay an easy multiple of 5 or 6 or 7 times of that price just to get it over here, given the transportation imbalances. So total cost of ownership in the new world where labor rates largely have equalized in most economies around the globe. There are still pockets in Indonesia and India and other places where labor rates are very low, but even Mexico is not really a low labor rate country anymore, and China certainly is not. So the opportunity for overwhelming cost advantage due to labor input has largely been used up or realized. And so total cost of ownership becomes much more important in that context.
One of the things that I find so fascinating is the network impact of lag when it comes to managing inbound and outbound freight, whether it's in trucking or whether it's in the shipping industry. If a ship shows up full at one port, it can't leave empty. It's got to leave full, right? And the dislocations that we've seen up until now in overseas shipping networks have been largely a result of a Chinese supply shock. And as the Chinese economy is coming back online, there's now a supply and demand shock on our end. So how is this playing out right now? Is this what we're seeing?
Yeah, well, so I guess I'll break that up into a couple of components. So bizarrely, you're right. I mean, no ship owner wants to send an empty ship across the Pacific Ocean, but we're actually seeing a fleet of empty container ships moving across the Pacific right now because they realize we have to get this balance reestablished. And the only way to do it is to move empty ships to the U.S., load that up with stuff that will be sent back to China, and begin to get trade regularized. And I actually think on the supply side of things, we're looking at a 6 to 8 week period of time, starting right about now and running for another 6 weeks, in which it will take us to get back to sort of the normal equilibrium in terms of trade balances, at least a movement of goods across the ocean between the two economies.
Tom, I have a question. I have a question on
Yeah.
that. Who takes the hit on that? Like, is there any kind of collaboration between shipping companies? Do the ship brokers play a role in trying to mitigate the fallout here?
Well, so in the first instance, the shipping company takes the hit, right? Because they're not getting paid. But on the other hand, they're going to pass that cost through to the extent possible. So rates will go up for shippers. So you'll eventually pay higher rates because they're going to want to recoup the cost of sending that empty ship.
But they unilaterally make this decision because couldn't they also wait, hold out, and hope that they'll get some freight to carry? I mean, how does that decision come about?
Well, because then you're talking about the opportunity cost of not moving anything. How long can I wait? If I'm in the shipping business and I get paid for shipping things, how long can my company afford to wait until things sort of get back to normal in China and the normal export flow from China resumes versus do I need to move a ship, even though it's going to take me 6 weeks to sail? Do I need to move it to the port of Long Beach, load it up, and bring it back? And is that faster and gets my business back to its normal cadence faster than just sitting on the sidelines until China comes back up to normal?
So was there fierce competition by the shipping companies to try and outbid other suppliers to get freight on so that they at least didn't have the empty vessels crossing the Pacific?
Yeah, well, I tell you where the fierce competition really played out was on the part of the exporters, the shippers. They want to get on those ships, and some of the stuff is time sensitive. Some of it is actually perishable, and so you need to move it or you lose it, right? So people were paying dearly to get. At one point in late February, if you wanted to move things on a private air charter from China to the United States, the earliest you could ship was mid-April. That's a very long time in supply chain. So people were willing to pay a lot to make sure they were getting ahead of somebody else in the queue and getting allocated space on that freighter.
You know, this is so interesting. We did an episode a few episodes ago with Josh Crum looking at gold futures. And his thesis was that this location that we saw, this backwardation that we saw in the COMEX gold futures market was a result of the supply chain disruptions. And again, because a lot of times you can literally get gold shipped by air cargo because the weight versus the value is so small, but you obviously can't do that with lots of other things. So what are we learning about which companies have done a good job of commanding their risks and which suppliers and intermediaries are more or less reliable to work with during this time?
Well, you really won't learn it at the supplier level. Well, those companies aren't household names. Very few of them are. And we really won't see a lot of data at the market moving level that affects, that flows from those companies. But what you will see as earnings announcements come out, in the next quarter, you'll see companies that are talking about their inability to react quickly, to be agile, and to respond. For instance, there's quite a lot of automotive manufacturing that happens in Wuhan. I was in Wuhan in November, and I've count my lucky stars that I got out of there before things really, apparently came to a crisis. But a lot of automotive manufacturing happens in Wuhan. It is literally up the Yangtze River from Shanghai, so it's easy to move things by barge down the river to Shanghai and then ship them overseas from Shanghai. And if you were in Wuhan and had a sense of what was happening in Hubei province and acted on it, you were ahead of the game. You had a chance to lock down some cargo shipment and make sure that your business was moving, as opposed to people who maybe were based on the east coast of China, and Beijing's a little bit inland, but Guangzhou or Shenzhen, Hong Kong or Shanghai, and they weren't aware of what was happening back in Hubei province. They were going to be at a disadvantage.
So one of the things that I read is that Wuhan, and actually also the parts of Italy that were most affected by COVID-19, are actually central in the medical supply chains, that a lot of masks and gowns and protective equipment come from those areas. Is that right?
Yeah, that's right. Quite a lot of in fact, there was now a fairly famous incident where one of the manufacturers for protective gowns, the gowns not that the patients wear, but that the healthcare providers wear, the doctors and nurses and therapists, they switched manufacturers, and that manufacturer had a quality issue. And so we had pallets full of gowns that were unusable in the United States in a healthcare setting. And we had to find a new supplier. So we, at the worst possible time, we had a supply chain disruption on that piece of personal protective equipment. We also have lots of latex gloves. We have surgical masks that people use to protect themselves, those plexiglass shields that you sometimes see in surgical theaters. And a lot of that stuff comes from China, not to mention a lot of the more sophisticated electronic components that go into things like pacemakers and other medical devices. A lot of that core stuff is coming from China, or some of the core, you think about a knee replacement or a hip replacement, some of the machining that has to happen to make those joints, that happens in China. So there's a high degree of reliance in the healthcare industry specifically on China as the source of base chemicals, basic machining, low value manufacturing, but of highly important product like personal protective equipment. A lot of that is based in China.
So how many of these shortages have we already seen from the disruptions, and what percentage are we yet to see, do you think?
Well, I'd break that down into a couple of examples. I think if you're a consumer and you're thinking about your favorite brand of shampoo or your favorite household product, you're just beginning to see that now. I would tell consumers to expect to see between now, the beginning of April and the beginning of June, shortages on shelves of common products that we typically buy every day or every week. And something a little more sophisticated like healthcare, obviously we're seeing a significant effort to ramp up production in certain key areas like ventilators and other products in the United States. I'm also aware of very laudable efforts, private efforts for hospitals and health systems, for instance, to share information about the inventory they have on hand. The term they use is days on hand of N95 masks or the gowns or latex gloves. I've seen some private data that would indicate that some health systems are actually good. They have 60-day supply, which would be the normal amount they would carry. And I've seen hospitals and healthcare systems reporting 1-day supply or 3-day supply. So to avert the crisis in the immediate term for those systems that are really in crisis right now, some sharing of inventory, privately across the network makes absolute sense. I do think that we're experiencing some critical shortages and some key components that is going to get a little worse before it gets a little better while we ramp up some production in the United States.
Like what's an example? Because I know that masks have been affected, obviously.
Yeah, but so for instance, 3M in the United States is ramping up its production of masks, and other companies are retooling in order to be able to produce some masks. So that masks, I think, will be okay. But I think some of the pharmaceuticals might take a little longer to get up to speed. Anything that's FDA regulated takes a while because the new supplier has to be qualified by the FDA. I don't want to be too alarmist. I don't think that we're going to be in such a precarious situation that people aren't going to have the equipment they need to protect themselves or to take care of patients, but stocks will get low. And there's been an argument that from a public policy perspective, we might want to consider requiring or incenting companies to keep some of their production here in the United States, just like we do with the defense industrial base for national security reasons, so that when the next pandemic hits, we're a little bit less vulnerable. Much like we had the Strategic Petroleum Reserve in the wake of the Arab oil embargo back in the 70s.
Right. I mean, I think that's one of the things that we're discovering, which is just how vulnerable we are to disruptions to the supply chain. And certainly to certain key areas. We're fortunate in the United States that we can source so much of our food supply within our borders. We're unique in that sense. And I do want to actually discuss the food supply chain with you. Before we switch off, though, I have kind of two questions that are not related to the actual underlying economy, but to the financial or the legal economy. And that has to do with contract compliance and disputes. I mean, so many of these suppliers have contracts with each other, right? So we talk about this daisy chain. How is that playing out right now? And what are we learning about what companies manage this better than others? I mean, could a company manage this on the contract level in a way that heading into this crisis that would have been more prudent than another, let's say?
Well, that's a very insightful question, and we're learning a couple of very significant things. So this term in the law that relates to contracts known as force majeure, and it basically relates to what we would call in common English as acts of God. So if a war were to break out, if there was a pervasive natural disaster like an earthquake or a tsunami, events of that nature, there's an out in the contract that says, in the event of a force majeure event, I'm not going to be obligated to meet my obligations under this contract. A lot of suppliers are invoking force majeure right now, saying coronavirus is a force majeure event. And if you're a buyer, here's what the thinking is right now. Well, it is kind of a force majeure event, but you also are required to have a business continuity plan. And so going forward, we're going to be much more rigorous in understanding what your business continuity plan is. So even if you invoke an act of God type event, I want to understand what your continuity plan is to maintain at least a minimum level of production. Sometimes it's referred to as a service level agreement. At the same time, on the demand side, if you're a U.S. company who's worried about the demand shock in the U.S. economy for your ultimate customers, and so you want to minimize the stock you're building up and maybe you're manufacturing or the orders you're building, you might go back to your suppliers and tell them you're not going to honor your minimum volume requirements. So that's the buy side. Force majeure on the supplier side. On the buy side, I know we committed to getting 100,000 units a month from you, but we're just going to tell you outright we're not going to do that, and sue us if you want to. But there's no way we're going to be able to maintain that. Going forward, there has to be, if you're purely relying on contract terms to enforce your relationship and to maintain the equilibrium between the two companies, that's usually the worst way to manage a relationship with a company. The other thing that's happening is these smaller suppliers are in real financial stress. And so some of the bigger companies are finding innovative ways to give them an economic lifeline. It might be a commitment to a lifetime buy of a part. We'll buy every component you can make in that category over the life of our product life cycle. Or it might be, we're going to give you better payment terms so that you've got better cash flow so that you can support your business through better cash flow, right? We're not normally we might pay in 60 or 90, 120 days, but a temporary basis for the next 6 months, we're going to pay you in 45 or 30 days to help you with the cash flow. So these kinds of things happen in order to make sure that critical suppliers remain in business and don't go out of business, because without them, I don't have a business. So those kinds of conversations are happening every single day right now.
Fascinating. How is this impacting cash flow needs, right? Because this is obviously has a huge impact on cash flow, and companies have lots of debts and they need to service those debts. So how is that being impacted here?
Well, and I would throw in another factor, which is a lot of companies have dollar-denominated debts.
Absolutely.
And their cash flow is not in the dollar. So those companies are really in trouble because they've got to satisfy their debt obligations in dollars, but they aren't making sales enough to raise the dollars to satisfy those debts potentially. So that's a particular, a sort of capital market intersection.
And obviously, in terms of the macro economy, that is an appreciating force on the U.S. dollar. Again, this is, one of the things that a lot of people don't realize is that one of the reasons that the dollar has so much value is because it's used internationally and because so many debts and liabilities are denominated in dollars. And a lot of companies during contractions need dollars to service their debts. So that drives up the value of the dollar and the demand for dollars worldwide.
That's right. And I believe the Fed is actually making supply of dollars available to central banks around the world to help kind of address some of that, what could otherwise be a scarcity or a shortage. And a strong dollar for a U.S. manufacturer exporting is actually a disadvantage, right? Because now I've got a price differential for someone who has to buy dollars to buy my product. But from a financial stress point of view, that's something that we have to really pay attention to in supply chain, because typically the companies we buy from are much smaller than the brand names we know as consumers. And they are living hand to mouth typically from a cash flow point of view. And if things get out of balance for them, if they're having to pay for inventory to produce components to sell for us, and they've got to pay their own supplier in 30 days' time, but they're getting paid in 90 or 120 days by the customer, that creates a cash flow imbalance, right? And that's the only way to actually survive that over the short term is to taking on some debt, maybe resort to some supply chain financing, or maybe factor your receivables, all of which are not desirable because that ultimately means you're discounting your sales. So there are real stresses that the smaller suppliers are undergoing. And I know that the bigger companies are aware of those, follow the financial condition of their smaller suppliers, and will definitely want to help to the extent they can the smaller suppliers be able to get through this tough patch so that they're around for whenever the normal economy returns.
Mm-hmm. And to your point about the Fed, they've set up a number of dollar swap lines with central banks, including emerging market countries, though notably not China. Before we move it to the overtime, Tom, I want to ask you one more thing about supply chains for food and agriculture, because when we do get into the overtime, I want to get your assessment on the impact to telcos and MSOs, the automotive space, commercial air travel, as well as the market for tankers, because the price war in global oil markets has fueled significant demand for crude tankers despite the global slowdown. Also, I want to ask you how you think companies will or should think about positioning themselves coming out of the other end of this contraction. What are the long-term impacts in terms of rerouting some of these supply chains and rethinking the scale and efficiency of distribution and sourcing? But before we do, I'd love to get your take on how the current disruptions have impacted or will impact our food supply systems. It's something that people have obviously been very concerned about. There's been a lot of hoarding happening the past month or so because of the panic inspired by this virus. How has COVID-19 impacted food supply chain networks around the world during this time, and how should we expect them to be impacted over the next 6, 12, or even 18 months?
Well, you were right earlier in the program, Demetri, when you alluded to the fact that we are relatively self-sufficient in this country when it comes to our basic food supplies. We're a net exporter of many food products, including grains and soy and beef and other meats and poultry. So we really have no reason to be concerned about we also have, for the food manufacturing side of our economy, those companies, the ConAgras of the world and others, they've got a distributed global manufacturing footprint. So even if they run into an issue in a plant in, let's say, China, they're able to shift production over time to Canada or to Mexico or to some other place, so that the risk of even a medium-term interruption in food supplies in the United States is negligible. So a word of advice to the consumer out there who might be listening to this would be, don't be worried about whether you're going to be able to buy eggs or milk or bread or meat or fresh produce. That's going to be available. And it's really not at risk here in the United States. We're very fortunate in that regard. It's not the case in many other countries of the world, as we know. So we're very fortunate to have that situation here in the United States.
And that leads us to a conversation about warehousing and distribution, which have seen a huge surge in hiring in the face of what has been otherwise a deluge of layoffs. Tom, I'm going to move us into the overtime. For regular listeners, you know the drill. If you're new to the program, or if you haven't subscribed yet to our audiophile, autodidact, or super nerd tiers, head over to patreon.com/hidden forces, or scroll down to the summary section of this week's episode and click on the link that sends you to the Hidden Forces Patreon page, where you can continue to listen to my conversation with Tom, including gaining access to the transcript of today's conversation, as well as this week's 19-page rundown, which includes all of the research and information that I compiled to prepare for this episode. Also, don't forget, if you haven't integrated the Patreon RSS feed into the podcast application that you use to listen to the regular episode, you need to do that. The overtimes download directly to your phone, and you'll be able to listen to them just like you listen to the regular episodes. Tom, stick around. We're going to continue our conversation into the overtime. Today's episode of Hidden Forces was recorded in New York City. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription, available through the Hidden Forces website or through our Patreon page at patreon.com/Hidden Forces. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.